What if everything looks fine until it suddenly isn't? Right now, the UK is walking a financial tightrope. Bills are rising, wages are frozen, and interest rates are squeezing families dry. Behind the headlines and political promises, something far more serious is brewing. A potential financial collapse that could affect every single household in the country. Still think it's just media hype? Here's the reality. Experts are warning of a dangerous storm made up of sky-high national debt, crippling energy prices, housing bubbles, and economic policies that no longer work. And yet, barely anyone is talking about how all these cracks are beginning to connect. So what happens when they do? This isn't just about the economy. It's about your rent, your job, your savings, and your ability to afford food and heat in the coming months. And what's scarier, most people won't see it coming until it's already too late. In this video, we break down the 10 most alarming reasons why the UK could be heading straight into a financial meltdown. These aren't conspiracy theories or wild guesses. They're based on real trends, real data, and the kinds of facts most media outlets simply gloss over. If you're not paying attention now, you might regret it later. Stay with us, because by the end, you'll see the full picture, and you'll understand why it's not just a crisis. It could be a collapse. Number 1. Soaring national debt. The UK's national debt has reached a staggering £2.6 trillion, and it's still climbing. That's over 100% of the country's GDP, meaning the UK owes more than it produces in an entire year. This isn't just a number on a spreadsheet, it's a ticking time bomb that affects every household, every job, and every pound in your pocket. Think of it like maxing out your credit cards and then borrowing more to pay off the interest. Eventually, lenders start to worry. They may demand higher interest rates, or worse, stop lending altogether. That's when the real trouble begins. The government is then forced to either print more money, causing inflation, or impose austerity measures, cutting funding to essential services like healthcare, education, and public transport. This debt surge didn't happen overnight. Years of pandemic spending, energy subsidies, and interest payments have created a fiscal snowball rolling downhill. And as the Bank of England raises rates to fight inflation, the cost of servicing the debt skyrockets. We're talking billions more every year just to cover interest. Money that could have been used for infrastructure, housing, or schools. The signs are already here. Credit rating agencies are downgrading the UK's economic outlook. International investors are growing cautious. The more debt the government carries, the less room it has to respond to future crises. That's dangerous in a world facing climate shocks, geopolitical tensions, and economic instability. What does this mean for you? Expect more tax hikes, reduced public spending, and a growing sense of financial pressure. Your cost of living may rise, while support from public services shrinks. That's the real impact of a bloated national debt. Not just numbers, but a visible strain on everyday life. Is the UK prepared to weather the storm, or are we standing on the edge of a financial cliff? Number 2. Persistent inflation pressure. Inflation in the UK isn't just lingering, it's refusing to budge. Despite the Bank of England's aggressive interest rate hikes, prices for essentials like food, fuel, and housing continue to climb. While many countries have seen inflation retreat, the UK's rate remains one of the highest in Western Europe. What's fueling this relentless pressure? It's a mix of global and domestic factors. Energy prices surged due to the Ukraine conflict, and the UK's heavy reliance on energy imports magnifies the shock. At the same time, Brexit-related trade frictions have increased the cost of bringing in goods. Add to that a tight labour market and supply chain issues, and you've got the perfect storm. But inflation isn't just about higher prices, it's about shrinking buying power. When wages don't keep pace, your money buys less each month. A grocery bill that used to be £50 is now closer to £70. Utility bills feel like a second mortgage. Over time, this wears down not just wallets, but consumer confidence and economic momentum. Even more concerning is the impact on savings. Money sitting in a bank account loses value in real terms. That's especially harmful for pensioners and low-income families. Businesses also suffer. Rising costs force them to increase prices or cut jobs, neither of which helps the economy recover. And the pressure isn't easing. Core inflation, stripped of volatile items like food and energy, remains stubbornly high, signalling entrenched price growth. This forces the Bank of England into a corner: raise rates further and risk a recession, or hold steady and let inflation erode living standards. Everyday decisions, buying groceries, heating homes, saving for the future, are being shaped by inflation's grip. The question is no longer whether prices are rising, but how long people can cope. If inflation keeps tightening its grip, the UK could find itself locked into a cycle of economic stagnation, public unrest, and fiscal panic, a recipe no one wants to taste. Number 3. Interest rate volatility. The UK's battle with inflation has triggered a wave of interest rate hikes unlike anything seen in recent memory. The Bank of England has raised its base rate multiple times, sending shockwaves through the housing market, business loans, and consumer credit. What started as a tool to cool inflation has now become a source of financial stress across the country. Higher interest rates make borrowing more expensive. Homeowners on variable rate mortgages have seen their monthly payments soar by hundreds of pounds. First-time buyers are being pushed out of the market entirely. For businesses, especially small and medium-sized ones, the cost of capital has spiked, forcing many to delay investment or even consider layoffs. This isn't just a blip. The rate hikes are exposing underlying vulnerabilities in the UK's economic structure. People borrowed heavily during the era of ultra-low rates, believing those conditions would last. Now, many are over-leveraged, with personal debt levels rising while incomes stay flat. The result? Payment defaults, shrinking credit access, and a deepening consumer slowdown. Even savers aren't safe. While higher rates should reward saving, banks are slow to pass on returns. So savers get little benefit while borrowers get squeezed. It's a system that feels stacked, generating public frustration and financial uncertainty. What makes this worse is the volatility. Rates are changing fast and markets are jittery. Investors can't predict what's coming next. Businesses can't plan. Families can't budget. This constant instability breeds fear, discourages spending, and amplifies economic drag. There's a tipping point where rate hikes stop being helpful and start being harmful. Many experts believe the UK is approaching that threshold. With households stretched, businesses tightening belts, and confidence eroding, the side effects of interest rate policy could become more damaging than the inflation they aim to cure. This is no longer just an economic issue. It's becoming a social strain, affecting the daily lives and future plans of millions. Number 4. Stagnant wage growth. For over a decade, wages in the UK have failed to keep up with the rising cost of living. While prices for food, housing, transport, and utilities have surged, real income, the amount people actually take home after adjusting for inflation, has remained largely frozen. This has created a growing gap between what people earn and what they need to survive. Imagine working full-time and still struggling to cover basic expenses. That's the reality for millions across the country. From nurses and teachers to delivery drivers and retail staff, workers are feeling the squeeze. Many have taken on second jobs or side hustles just to stay afloat. The rise in zero-hour contracts and gig economy work hasn't helped either, leaving people with unstable income and minimal job security. The problem isn't just about paychecks, it's about dignity and quality of life. People are putting off buying homes, delaying having children, and skipping holidays, not by choice, but by necessity. It's harder to save, harder to invest, and harder to plan for the future. Financial stress is also taking a toll on mental health, with reports of anxiety and depression linked to economic hardship climbing steadily. And while profits soar in some sectors, the average worker sees little reward. Executive pay packages continue to grow, creating a sense of imbalance and economic injustice. Many feel the system rewards the top while leaving everyone else behind. Stagnant wages also hurt the broader economy. When people spend less, businesses earn less, leading to slower growth, layoffs, and more instability. It's a vicious cycle. Low pay leads to low spending, which leads to weak demand, which then discourages wage increases. Without significant action, this wage stagnation will continue to erode living standards, deepen inequality, and fuel public discontent. A strong economy isn't built on corporate profits alone. It relies on the financial well-being of its workers. Number 5. Energy dependency crisis. The UK's heavy reliance on imported energy is becoming a dangerous liability. Over 40% of the nation's energy supply comes from foreign sources, including natural gas and oil. This dependency means the UK is at the mercy of global market fluctuations, political tensions, and supply chain disruptions. When Russia invaded Ukraine, gas prices soared, and households across Britain felt the impact instantly. Heating bills doubled, small businesses struggled to keep lights on, and entire industries, like manufacturing and agriculture, were forced to cut back operations. These shocks aren't just temporary spikes. They expose a fragile system that lacks self-sufficiency and resilience. Renewable energy is growing, but it's not yet strong enough to meet the country's full demand. Wind and solar farms still rely on weather patterns, and infrastructure limitations mean that energy often can't be stored efficiently. Until the UK can scale these solutions, foreign dependency will continue to pose a major economic threat. High energy prices don't just affect utilities. They inflate transportation costs, raise food prices, and increase production expenses. These rising costs ripple through every sector, pushing inflation higher and making it even harder for ordinary people to afford daily essentials. Meanwhile, government responses often lag behind the crisis. Temporary energy subsidies and price caps provide short-term relief, but they aren't sustainable. Long-term solutions like nuclear expansion or domestic gas exploration take years to develop. In the meantime, households are left exposed. Geopolitical instability adds fuel to the fire. If another conflict breaks out, or if supply from key exporters is interrupted, prices could spike again, possibly even higher than before. The lack of energy independence leaves the UK vulnerable not only economically, but strategically. Until the country builds a reliable, affordable, and domestic energy infrastructure, it will continue to be held hostage by forces it cannot control. That's a risky position for any economy, especially one already under pressure from multiple directions. Number 6. Housing market bubble. Across the UK, property prices have surged far beyond what most people can afford. For years, low interest rates, limited housing supply, and aggressive real estate speculation have driven prices higher and higher. Today, the average home in some areas costs over 10 times the median salary, creating one of the least affordable housing markets in Europe. This rapid price growth has created a bubble, a fragile structure where even a small shift in conditions could trigger a sharp market correction. Rising interest rates have already cooled buyer demand. Mortgage approvals are falling, and sellers are beginning to slash prices just to attract offers. But for many who bought at the peak, the damage is done. Negative equity is becoming a serious threat. That's when the value of a home falls below the amount still owed on the mortgage. It leaves homeowners trapped, unable to sell, unable to refinance, and stuck paying more for a property that's worth less. For first-time buyers who stretch themselves thin just to get on the ladder, this could be financially devastating. The ripple effects don't stop with individuals. A sudden drop in house prices would hit construction firms, estate agents, banks, and local economies. Fewer new homes means fewer jobs. Declining property values mean less council tax revenue, straining public services. And banks holding too many high-risk mortgages could face serious losses. Rental prices are no escape either. As buying becomes impossible for many, demand for rentals has soared, driving rents up to record highs. Families are being forced to choose between affording rent or cutting back on food and essentials. The dream of home ownership is slipping away, especially for younger generations. If the housing bubble bursts, it won't just impact buyers, it could lead to a broader economic downturn, wiping out wealth, slashing spending, and increasing financial hardship across the board. A stable housing market should support, not suffocate, its people. But right now, the system feels like it's balancing on a knife's edge. Number 7. Brexit aftershocks. Years after the UK officially left the European Union, the economic consequences of Brexit are still unfolding, and they're more damaging than many expected. The promise of sovereignty and control came with a heavy price tag: trade barriers, labour shortages, and a significant drop in foreign investment. Since Brexit, the UK has faced rising import costs due to new customs checks, regulatory red tape, and reduced access to European supply chains. This has especially hurt small and medium-sized businesses that depended on frictionless trade with EU partners. Many are now paying more for raw materials, waiting longer for shipments, or losing contracts altogether. The impact on exports is just as severe. British goods are facing additional paperwork, tariffs, and delays at European borders. Some companies have even relocated operations to the EU to avoid the complications, taking jobs and tax revenue with them. It's a slow bleed that undermines the UK's position in the global marketplace. One of the most visible effects is the labour shortage, particularly in sectors like agriculture, hospitality, and healthcare. With tighter immigration rules, many EU workers left, and fewer are returning. The result: empty shelves, understaffed services, and businesses unable to meet demand. Foreign investors are also cautious. The uncertainty surrounding UK-EU relations, regulatory divergence, and economic unpredictability has made the UK less attractive as a base of operations. London, once a magnet for global capital, is now watching other cities take the lead. Even larger trade deals with non-EU countries haven't fully replaced what was lost. The volume, efficiency, and proximity of EU trade simply can't be matched by distant markets, at least not in the short term. For ordinary citizens, this means higher prices, fewer job opportunities, and slower economic growth. The aftershocks of Brexit are no longer political talking points. They're tangible realities affecting wallets, businesses, and futures every single day. Until these issues are resolved, or at least stabilised, the UK remains caught in a period of uncertainty and adjustment, dragging on an already fragile economy. Number 8. Underfunded public services. The cracks in the UK's public services are widening, and funding shortages are at the heart of the problem. From the NHS to education, from local councils to police forces, essential services are being stretched to their limits by years of budget cuts, rising demand, and a lack of sustainable investment. Let's start with the National Health Service. Staff shortages, record-breaking waiting times, and overwhelmed emergency departments have become normal. People are waiting weeks for GP appointments, months for surgeries, and in some cases, hours just to be seen in A&E. Behind the scenes, medical professionals are burned out, underpaid, and leaving the system entirely. In schools, funding per pupil has fallen in real terms. Teachers are paying out of pocket for classroom supplies. Buildings are outdated, support staff are scarce, and special education services are under immense pressure. These conditions don't just affect teachers. They directly impact students' learning, future prospects, and mental well-being. Local councils are declaring effective bankruptcy. Libraries are closing, road repairs are delayed, and community programs are being scrapped. Even basic services like rubbish collection and social care are being reduced or outsourced. Communities are being left behind, especially in deprived urban areas and rural regions. The police and justice system are also under strain. Rising crime rates are met with falling conviction rates. Courts are backed up for months, even years. Victims wait endlessly for justice, while offenders walk free due to lack of resources. All of this contributes to a cycle of social instability. When healthcare fails, education weakens, and community services vanish, the burden shifts to individuals, many of whom are already struggling. It becomes harder to escape poverty, stay healthy, or feel safe. Well-functioning public services are not a luxury. They are the foundation of a stable economy and society. When they falter, everything else begins to crumble. The UK's current trajectory risks turning temporary austerity into a permanent state of decline, leaving millions to face daily challenges alone. Number 9. Banking system vulnerabilities. Beneath the surface of the UK's financial sector lies a growing risk. The banking system's exposure to commercial real estate and high-risk lending. While big banks appear stable on paper, a closer look reveals mid-sized and regional lenders carrying significant amounts of volatile assets, particularly in sectors like office space, retail properties, and leveraged corporate loans. As the demand for office space declines, driven by remote work and changing business models, many commercial buildings are sitting empty or undervalued. At the same time, retail centres face declining foot traffic and reduced rental income. This shift is dragging down the value of properties, and with it, the financial strength of banks that lent heavily in those areas. If enough property owners default on loans, banks could face liquidity problems. These aren't just theoretical risks. We've already seen warning signs: delayed repayments, shrinking loan portfolios, and rising loan loss provisions. For smaller lenders, a series of defaults could spark a domino effect, causing confidence in the system to falter. The risk doesn't end with commercial real estate. Consumer credit is growing again, particularly among households already burdened by mortgage payments, inflation, and stagnant wages. If economic conditions worsen, loan defaults could surge, triggering panic among lenders and investors. The UK is also tightly linked to the global financial system. If international banks falter or foreign investments pull out, those shocks will ripple into the UK's markets. The 2008 financial crisis showed how interconnected and fragile banking systems can be when risk exposure is underestimated. While regulators have made improvements since the last crash, shadow banking, fintech lending, and private equity debt remain under-regulated. These areas lack transparency and could act as pressure points if the economy stumbles. A resilient economy needs strong and stable banks, but when those institutions carry hidden risks, the foundation becomes shaky. Without tighter oversight and smarter risk management, the UK may be heading toward another banking scare, one with widespread economic consequences. Number 10. Geopolitical uncertainty. The global landscape is becoming increasingly unstable, and the UK's economy is deeply exposed to international events. From the ongoing Russia-Ukraine conflict to escalating tensions in the Middle East and fears of a confrontation between China and Taiwan, every geopolitical ripple sends waves through the UK's financial markets, energy supplies, and trade flows. These aren't distant problems. When conflict breaks out abroad, it drives up the cost of oil, natural gas, and key imports. That means higher prices at UK petrol stations, rising energy bills, and increased production costs for British businesses. When the Suez Canal was disrupted, shipping times to the UK doubled. When sanctions hit Russia, gas bills skyrocketed. These connections are real, immediate, and economically damaging. Investor confidence is also shaken by uncertainty. The UK, already burdened with debt, low growth, and political volatility, becomes a riskier bet. International capital begins to flow elsewhere, weakening the pound and pushing up the cost of foreign goods. A weaker currency fuels imported inflation, further straining households. Military tensions also disrupt supply chains. From microchips to pharmaceutical ingredients, many products the UK relies on are made or sourced in geopolitically sensitive regions. A single blockade, embargo, or diplomatic standoff can interrupt access, leaving industries scrambling to adapt and consumers paying the price. The UK's role on the world stage has shifted post-Brexit, reducing its influence in EU policy and changing its defence and trade alliances. It now must navigate global uncertainty more independently, without the buffer of a collective European strategy. That puts even more pressure on policymakers to anticipate and respond to fast-changing events with limited resources. Geopolitical volatility creates an environment of fear and hesitation. Businesses delay investments, households pull back spending, and governments focus on damage control instead of growth. The longer instability continues, the harder it becomes to plan, grow, or recover. When global risks escalate, nations with economic vulnerabilities, like the UK, feel the heat first. Without stronger buffers, smarter diplomacy, and robust energy and trade policies, the UK may be forced to react rather than lead. What's happening across the UK isn't just a series of random issues, it's a perfect storm of economic fragility. Each of these 10 warning signs, on its own, would be cause for concern, but together, they reveal a much deeper problem, a system that's slowly unravelling under pressure. From the weight of national debt to the shaky housing market, from unstoppable inflation to crippled public services, the signs are no longer subtle. They're loud, visible, and increasingly unavoidable. While governments debate and central banks react, ordinary people are the ones caught in the middle, paying more, earning less, and facing a future that feels more uncertain by the day. The truth is, financial meltdowns rarely begin with a crash. They start with slow leaks, overlooked warnings, and silent shifts in the background. By the time panic sets in, the damage is already deep. The UK may not be in free fall yet, but the indicators are flashing red. Whether it escalates into a full-blown crisis depends on choices made today, not tomorrow. And in uncertain times like these, awareness isn't just important, it's everything. Because sometimes, the most dangerous part of the storm is what you don't see coming. We dive deep to bring you truths others won't tell you. So if this opened your eyes, drop a comment below and share what shocked you the most. We put hours into making these videos, and your one click to subscribe means the world to us and helps keep the truth alive.